Hi everybody, welcome back to the BizTech Academy. Steve here, and today I'm trying out a different type of video. Recently I've been focusing on analysis and news concerning a few companies that are listing on the UK's alternative investment market. I will be continuing these news items, but I wanted to expand on these and look at some of the top investors and business leaders across the globe and what makes them successful and how these traits can be used by the likes of me and you to improve our investment decisions. And who better to start with than the greatest investor of all time, Warren Buffett. Before I jump in though, and as always, I must add that none of this is financial advice. I'm not a financial advisor, and everything I say today is purely my opinion. And in the interest of transparency, I do not hold today any shares in Berkshire Hathaway. And of course, if you do like this video, it is a new format, as I mentioned before, please give us a thumbs up and subscribe to the channel. I'm more than happy to carry on this type of video if it's of interest. Now, in this video, I'm going to explore 6 statements from Warren Buffett himself that explain the 6 rules, or if you like, mantras, that he follows when he makes investments. Of course, you don't have to agree with all or any of these rules. The purpose of this video is not to convince you either way. That said, let's put Berkshire Hathaway's success into at least a little context. Berkshire Hathaway was created in 1839 as a textile manufacturer, and Warren Buffett bought it in 1965 and over time created into an investment vehicle. If you had invested $1,000 in Berkshire Hathaway in 1972, that would have got you 133.33 shares. At today's share price of $527,750 per share, that means your original $1,000 investment would now be worth over $70 million. Note that Warren Buffett has never allowed a share split of Berkshire Hathaway, despite the high price of the share. Okay, with that in mind, let's look at Warren Buffett's 6 rules of success, but note that these rules are not in any specific order. Rule 1, and the first one I'm going to look at, is staying in your circle of competence. So let's hear what the man has to say.
Defining your circle of competence is the most important aspect of investing. It's not how important, how large your circle is. You don't have to be an expert on everything. But knowing where the perimeter of that circle of what you know and what you don't know is, and staying inside of it, is all important. Tom Watson Sr., who started IBM, said in his book, he said, "I'm no genius," he said, "but I'm smart in spots, and I stay around those spots." And, that is the key. So if I understand a few things and I stick in that arena, I'll do okay. And if I don't understand something, but I get all excited about it because my neighbors are talking about it, stocks are going up and everything, I start fooling around someplace else, eventually I'll get creamed, and I should.
Interesting, right? And as he says, staying in your circle of competence is the most important aspect of investing. And I think by this he means if you don't understand what the company does or you don't understand the business model, walk away. That said, what it doesn't mean is that you need to understand all the technical complexities about all the products or the services that that particular company makes or provides. It means understand the business model of that particular company and what the positive and negative drivers are of that business model. More importantly, the circle of competence doesn't need to be large. If you know a lot about a small number of things, that's fine. Just focus on those things and ignore the peripheral noise. Okay, let's move on to the second rule. And the second rule is evaluate a company before you look at the price. And just note before I go over to the video clip of Warren Buffett explaining this rule, that the audio and video quality on this clip is not the best. So if you can't hear it well, just switch on the subtitles for this clip. They are correct. And of course, the most important thing is the message. Okay, let's hear what he has to say.
You can't keep always trying for the average person who's maybe never bought a stock before. What's your advice about that? You can't constantly sit there and wait and say, oh, it's going to go higher, it's going to go higher.
We don't even think about that. What we think about is how much is it selling for? How much do we think it's worth? When we bought it at $35 billion effectively, I felt the company was probably worth at least $100 billion.
How did it come to your attention? How do you find a stock like PetroChina?
I sit there in my office and I read an annual report, which fortunately was in English, and it described a very good company. And told about the oil reserves, told about refining, told about the chemicals, everything else. And I sat there and read it, and I thought to myself, this company is worth about $100 billion. Now, I didn't look at the price first. I look at the business first and try and figure out what it's worth. Because if I look at the price first, I'll get influenced by that. So I look at the company first. I try to value it, and then I look at the price. And if the price is way less than what I just valued it at, I'm going to buy it.
So for me, the message here is twofold. Firstly, and we all know this, do your own research and don't FOMO blindly into an investment. Whatever the asset is, make sure the due diligence is thorough and that you're confident that you have a relatively accurate valuation of that asset. The second point, as I see it, is to make sure that you remove all external factors while you're doing your research, including knowing what the current price of the asset is, because that may well sway your thoughts and your research and your ultimate conclusion on the valuation of that asset. Now, this video is not intended to be a tutorial about how you value a company or value a potential investment, but Buffett's third rule does touch on this, and it clarifies one particular criteria that he uses when he's looking at making an investment. And this is to only invest in productive assets. Let's hear what Warren has to say.
There are roughly 1 billion acres of farmland in the United States. They're valued at about $2.5 trillion. It's about half the continental United States is farmland. You could have all of the farmland in the United States. You could have about 7 Exxon Mobils, and you could have $1 trillion of walking around money. And if you offered me the choice of looking at some 67-foot cube of gold and looking at it all day, maybe touching it, fondling it occasionally, and then saying, do something for me, and it says, I don't do anything, I just stand here and look pretty. And the alternative to that was to have all the farmland in the country. Everything, cotton, corn, soybeans, 7 Exxon Mobils, just think of that. Add $1 trillion of walking around money. Maybe call me crazy, but I'll take the farmland.
I find this rule fascinating. For someone who has invested and many times invested unwisely in unproductive assets, this message really rings true. Investing in an asset that produces something is a real investment. Investing in an asset that doesn't produce anything on the hope that someone in the future will pay more for that asset is more akin to speculation than investment. For me, I'm not sure I fully agree with Warren Buffett in this particular case, but I will acknowledge, and I do acknowledge, that putting money into non-productive assets is certainly more risky than putting money into productive assets. Buffett's fourth rule is arguably 2 rules, but I'm going to group it into one, and this is don't waste opportunity, and if you do believe, go in big. Here's what Warren Buffett says about this rule, and what's interesting is that it's clear that he hasn't always abided by it.
But the biggest mistakes we've made by far, biggest mistakes I've made by far are mistakes of omission and not commission. I mean, it's the things I knew enough to do. They were within my circle of competence, and I was sucking my thumb. And that is really, those are the ones that hurt. They don't show up anyplace. I probably cost Berkshire at least $5 billion, for example, by sucking my thumb 20 years ago or close to it when Fannie Mae was having some troubles, and we could have bought the whole company for practically nothing. And I don't worry about that if it's Microsoft, because I don't know it. Because Microsoft isn't in my circle of competence. And so I don't have any reason to think I'm entitled to make money out of Microsoft or out of cocoa beans or whatever. But I did know enough to understand Fannie Mae, and I blew it. And that never shows up under conventional accounting. But I know the cost of it. I know. I passed it up, and those are the big mistakes. And I've had plenty of them. And unless I tell you about them in the annual report, and I resist the temptation sometimes, unless I tell you about them in the annual report, you're not going to know it because it doesn't show up under conventional accounting. But omission is way bigger than commission. There's big opportunities in life have to be seized. We don't do very many things, but when we get the chance to do something that's right and big, we've got to do it. And even to do it in a small scale is just as big a mistake almost as not doing it at all. I mean, you really got to grab it when they come.
Interesting, right? Berkshire Hathaway could have been far more successful than it already is. But seriously, I like this rule. I've certainly missed out on opportunities in the past, and that includes buying too late and selling too soon. In terms of the go big comment, and I know this is relatively obvious, I don't think he means go all in necessarily. What he actually means is that if you do believe in something, at least put enough in there to make it worthwhile if it is successful. The fifth and sixth rule are more practical rather than being associated with choosing assets. That said, they are of no less importance. The fifth rule is simple, and it's invest in yourself. And let's hear what Mr. Buffett has to say about this.
The best boat you can have is your own talent. They can't take it away from you. Inflation can't take it from you. Taxes can't take it from you. So when I talk to students, I see these students and I tell them, you're $1 million asset. I would pay you $100,000 to the MBAs for 10% of the earnings for the rest of your life. So that makes you $1 million asset. Now, if you can do something to increase that value 50%, if you can learn to communicate better verbally or in written form, and you become 50% more, that's $500,000 just by improving yourself. I mean, nobody can take that away from you. And so I urge everybody, when I talk to them in high school about this and colleges, just do develop the habits. You've got the brain power, you got the energy, but develop the habits of success and look around you at the people that you admire, and list what makes you admire them compared to somebody else that looks equally strong or equally talented. And those are things that you can do. I mean, just write them down. And people like people that they like them if they're humorous, if they're friendly, if they give credit to the other fellow. I mean, and they don't like them if they're stingy, or they overstate and overpromise and all those sort of things. Well, that's a decision you make. So I encourage everybody to build your own moat around yourself.
I think there's a great point made here. We are all responsible for our own destiny. And if we want financial freedom, and I'm sure that everybody watching this video does, then investing in yourself must be a priority. The final rule, and I could quite have easily made this the first rule, is that cash is not a good investment. Very wise words indeed, and let's hear what the sage has to say.
This is something that goes with your philosophy today. Get out of cash and get into assets, because we don't know what's going to happen to the dollar.
Well, cash is always a bad investment. When people said cash is king a year ago, I mean, that's crazy. I mean, cash wasn't producing anything, and it was sure to go down in value over time. And then you always want to be sure you have enough. I mean, it's like oxygen. You want to be sure it's around, but you don't need to have excessive amounts of it around. And cash, we will always have enough cash around. But anytime we have surplus cash around, I'm unhappy. I mean, I would much rather have good businesses than cash. And we found a chance in the last year thereabouts to deploy. We came in with something over $40 billion in cash, right. And we've got about $20 billion now, and we've had some earnings. So we put a lot of cash to work, and I like that. No, I'd much rather own a good business than have cash.
The bottom line here is that, like oxygen, make sure you have enough cash around you that allows you to live. But if you have surplus, invest it and make it work for you, because there's nothing more certain that $1 in your pocket today will be worth less tomorrow. Okay, that's it. I hope you liked the video. Like I said, this was a new format, so if you did like it, please give us a thumbs up and subscribe to the channel. And if you want more videos like this and you have some suggestions, just put them in the comments below. Okay, in the meantime, as always, thanks very much for watching, and I'll see you in the next one. Bye-bye.